Are you trying to get a loan for your business this year, but having trouble getting in front of the right people or presenting your business in the best light? You're not alone. Almost 50% of businesses face trouble when trying to get traditional financing from banks or other lenders. But today, I'm going to share actual tactics that our clients at Proseer are using to get loans from banks to fund acquisitions, growth strategies, inventory purchases, and more. Stay tuned to transform your loan application status from rejected to approval. Let's go. But before we get started, make sure you hit that like and subscribe button or that notification bell to help us reach other business owners that have similar problems. Our channel provides weekly strategies that help business owners like you save thousands on taxes and secure the capital needed for growth. All right, let's get started by understanding the lending environment. According to the latest Federal Reserve data, small business applications have seen a material shift. About 37% of businesses applied for financing this year, with half of those seeking $100,000 or less. Here's what's happening with approvals. Small community banks are approving 75% of applications, while large banks are approving 66%. Online vendors have seen their approval rates drop to 70%, whereas other non-bank lenders approve about 76% of the time, but this can come with added costs. We'll get there in a little bit. What's interesting, but maybe not surprising, is that the SBA remains a powerful lending tool for small businesses looking to grow or innovate. Now, the current landscape for interest rates is challenging because interest rates still remain high, with the Federal Reserve just starting to reduce their borrowing rates. We're hopeful that these rates will come down in the future, but it is still expensive to borrow money. Before approaching a bank or a lender, make sure you understand what type of loan you're looking for. Let's go through some options. So you might be borrowing $500,000 over the course of 3 years and needs to get paid back in installments. The interest rate will usually be set in the loan documents, or it could be floating if you have what's called a revolving term loan, where you can draw and pay back as you see fit. Now, often for a term loan, it's only going to be available for those companies that are established or have material assets that can support a loan if you default. For this reason, term loans are usually reserved for established businesses with strong credit. Next, let's talk about SBA loans. These are government-backed loans that typically come with lower down payments and longer payback periods. However, on the other side, they can be costly and the interest rates and payments would be higher on the payback term. In this scenario, the government is actually guaranteeing that the bank won't lose money if you don't pay them back. Because there's this guarantee, it comes with added cost to you, the borrower. Next, a business line of credit. Now, this can be set up similar to a term loan, but it gives you a lot more flexibility because you're not required to take all the money out and incur interest charges from the beginning. You're only charged interest based on the amount that you borrow and how long you keep that money before paying it back. This is typically a flexible funding option to support short-term operational needs that you're going to pay back in the course of a few months. Next, we can get into some asset-based loans. In this scenario, the lender is giving you money to purchase equipment or inventory or another specific asset with the idea that if you don't pay it back, they're going to take possession of those assets or that equipment. For example, inventory or equipment financing. Lastly, if you're in real estate, a commercial real estate loan or a construction loan. This is typically used to buy properties such as a building, a plant, some other sort of commercial real estate. Or if you're taking a construction loan, it's to build a commercial asset that you're going to use for your business. Each of these loan types has different qualification requirements and approval processes. For most small businesses, going an SBA route will allow you the greatest chance of success, but it comes with the added costs. As you grow and you have more experience, you'll be able to get traditional financing from a lender because they'll know that you're going to pay it back on time and you're going to have more assets to secure the loan. All right, let's move on to qualifications. But before we do, stay tuned towards the end where I'll reveal why your digital footprint matters more than ever to loan bank officers this year. Now for the critical part. What are the banks actually looking at when reviewing your application? First, if you're running a small business, your personal credit is going to be tied to that of the business. Both your personal and credit scores will be reviewed as part of your application. To get a traditional loan or an SBA loan, banks are typically looking at personal credit scores over 680 and clean business profiles without any liens or claims against the business. Also, time in business. Most banks want to see at least 1 to 2 years of operations, so they have some history to analyze. There are some SBA programs specifically for startups, but the terms are probably going to be more onerous than those for established businesses. The longer you're in business, the more history the bank has to analyze, and the better picture it could potentially paint for the loan officers. Next, cash flow documentation. This is absolutely critical. You have to be able to show that you're going to be able to pay back the loan. Banks want to see consistent, positive cash flow, with at least a 1.25 times debt coverage service ratio. This means your business generates at least 25% more than what's needed to cover all the debt payments. Next, they're going to look at collateral. What assets do you have that they can secure the loan with to make sure that they get paid back in case the cash flow of the business doesn't support the loan payments? This could include business or personal assets, equipment, or even real estate. Lastly, they're going to do an industry risk assessment. Depending on the economic cycle of your industry, a bank might place a higher or lower risk score on your business simply by operating in that industry. For example, currently retail, restaurants, and hospitality are facing higher scrutiny than other industries that don't focus on discretionary spending. So one important document that you can provide the bank to give them more comfort around your business is a cash flow forecast. This is something that many applicants miss because they don't know where to start, but it's actually not that hard to put together, but can make a big difference in telling your story through numbers. Typically, we recommend showing at least 12 to 24 months of projections and make sure that those projections are based in actual history and show the ability to pay back the loan. If you don't think you can pay back the loan, there's no way the bank is going to. In assessing the risk of the business, they want to understand what's happened in the past, but also they want to understand your story and your plan for the future. Your projection should include monthly revenue forecasts, detailed expense breakdowns, including what you're going to use the money for. They'll also want to see your debt service calculations, showing how your profit or cash flow is going to be used to pay back the loan, and even potentially a sensitivity analysis showing how your business is expected to perform in potential growth or downturn scenarios. By providing a cash flow forecast to your lender, you're going to be able to get them to focus on the actual nuts and bolts of the business, not make their own assumptions. It will give you a much better chance at showing them that you will be able to pay back their loan and not leaving them asking this question on their own. Coming up next, I'm going to share 3 application red flags that'll be sure to get your application rejected immediately. Here we go. First, inconsistent financial reporting. Banks aren't in the business of losing money, so they're going to do detailed analysis on your financials, and it's really important that there's consistency in the financial information you give them. If your tax returns don't match your financial statements that don't match your application, you're done before you start. Next, a weak digital presence. Banks are going to be checking your website, your social media, and your online reviews. It's important to maintain a positive online presence to control the narrative around your business. A non-existent or poorly maintained online presence can raise concern about your business's legitimacy and future viability. Lastly, an unrealistic loan purpose. Banks want to see that the loan that they give you will generate additional revenue or increase profits. Giving the lender a vague purpose for the loan, like working capital or something else generic, will increase the likelihood of getting rejected from the start. Now let's talk about timeline. Overall, you should prepare for the process to take about 60 to 90 days if you have everything in order. If you have your financials ready, it'll probably take 1 to 2 weeks to get everything organized and answer all the bank's initial questions. Once you submit your application, prepare to wait 1 to 2 weeks as they analyze the information, they come up with follow-up questions, and they do their own analysis. The initial analysis will likely be done by a lending officer who's making sure the package is ready before it goes to underwriting. Underwriting is where they do a detailed analysis of your business. They're going to do their own scenario analysis to make sure that they think that you can pay back the loan under even the worst circumstances. Between the initial loan officer review and underwriting, you can expect to wait about 2 to 4 weeks. As part of the underwriting, be prepared to answer some follow-up questions. They're likely going to ask you more information about your business, including what the loan will be used for, how the loan will specifically equate to additional revenue or growth, or other aspects of the business. Lastly, once you get the all clear from underwriting, it'll probably take 1 to 2 weeks for you to get the legal docs, have everyone review, and make sure you're comfortable with the terms in the legal agreement. Remember, a loan is a legal agreement between you and the lender. Once everyone's signed off on the paperwork, you're good to go and you got your loan. Congrats. Let's quickly talk about alternative funding options. If bank financing isn't working for you, consider these alternatives. But before we talk about these, I just want to issue a warning. Going through the bank is the safest route. It's a regulated industry that comes with a lot of risk if the bank doesn't follow the rules. If you go to a non-traditional lender, it might be easier to deal with, but it typically comes with higher costs and some risks in case things aren't paid back on time. You always want to make sure you know who the other side of the loan is. You want to know who you're doing business with. With that said, here are some options. Online lenders. This typically comes with a faster approval, but higher interest rates. You can expect to pay anywhere up to 20 to 25% depending on how quick you need the loan or what assets you have to secure the loan. Crowdfunding or peer-to-peer lenders. Now, these will come with smaller increments, but you might be able to get a loan in a couple weeks after you pitch it to the community. Lastly is revenue-based financing. This is also known as merchant cash advance because they're looking at your revenues and they're collecting directly from your revenue streams. You'll be able to draw based on your revenues, and they can collect directly from the merchants that are paying you back from credit cards or other funding sources. This is typically the most expensive, but it might be quickest to access capital. Each of these options has their own pros and cons, so make sure you research the lender and understand who they are and what the total costs of the loan are before you enter an agreement with them. Now that you understand the current lending environment and how to approach getting a loan, it's time to take some action. Reach out to us if you want some help navigating the process of approaching lenders to present your business in the best light. Don't forget to like and subscribe to our channel to make sure you receive the latest when it comes to finance and accounting news and recommendations as we release it on a weekly basis. Thanks for watching, and we'll see you in the next video.